Good afternoon, and here I am back in Nairobi after being in London for my daughter's graduation, and I apologize for our absence on the podcast, but that was the reason. Let me start with some macro thoughts. Friday, we saw that US non-farm payroll number, which was a bit more muscular than the market had been positioned to expect, and that's why we saw a big bump higher in US two-year yields, up 11 basis points. This is from Sun Chartist. And on the 1st of July, I'd said that if I were back at my desk at Credit Suisse, I would be limit short the euro-dollar market as at Monday, and that would have paid off quite handsomely. And I concluded my article by saying reality will soon intrude on this reality show. The US 10-year Treasury yield spiked back above 2% after stronger than expected payrolls growth. Negative bond yields, look at this. This is what I meant when I was talking about us being in nosebleed territory and how this is voodoo economics. And then a fantastic article by Raoul GMI, and Bund yields will keep falling too, he said. Using a regression channel, it would suggest that minus 1.6% is the objective. And just let me read a synthesis of his tweets. He says the knock-on effects are all lining up to push one bank after another off the cliff of death. And there ain't a thing the ECB can do about it, as they have only one mandate: inflation. They have to cut rates, and that is why Christine Lagarde has been brought in. The ECB is going to need to become political. It is going to have to rescue an EU-wide banking system and put the banks into state hands and buy the extra government debt. And they're going to need to force fiscal reforms and massive fiscal stimulus. They will use the situation to force through tighter EU fiscal consolidation, maybe even leaving some nations behind. Lagarde is perfect for that role. It's what the IMF does. She's also a lawyer and a politician. The problem is, this stuff takes time. The ECB will buy any credit instrument to avoid capital markets seizing up, but shareholders are going to sense an equity wipeout over the debt holders. So equities bear the brunt of it, and bunds go more negative. The dollar will get bid, as the dollar funding crisis cannot easily be solved by the ECB, and lending at the margin tightens, and a stronger dollar would destroy the banks and the global economy. It's all very circular, and there are few circuit breakers. Throw in heightened trade wars between the EU and the US, highly likely, and China, EU, US, and you have a very big issue. And my problem with all of this is that the probability is much higher than I'd like. And that is the reason to own bonds, dollars, Bitcoin, and gold. The former two are the beneficiaries of current needs, and the latter two are the high gamma options on this escalating into an extreme policy event. It's very well put, I thought.